Buffett's first Itochu buy came after a long stretch in which Japan's economy was basically slow growth, low inflation, and structurally stable, while Itochu was shifting away from a resource-heavy trading mindset toward consumer, food, apparel, convenience store, and other non-resource businesses. The big 2019 profit jump was mostly the result of real operating strength in non-resource businesses, plus a sizable accounting/portfolio effect from consolidation and one-time items, not just a simple business suddenly doubled story. Japan from 2015 to 2019, Japan was still living in a low-growth environment over this whole period, with real GDP growth roughly around 0.8% in 2016, 1.7% in 2017, 0.6% in 2018, and negative 0.4% in 2019. That means the macro backdrop was not a roaring domestic boom. It was more a mature economy with modest expansion and lots of sensitivity to global trade and consumer spending. For Itochu, that kind of environment actually fit its strategy better than a resource boom would have. In its 2016 report, Itochu emphasized asset replacement, cash flow discipline, and building a stronger non-resource earnings base, especially in consumer-related businesses such as textiles, food, general products, machinery, and alliances in China and Asia. Itochu's business shift from 2015 to 2019, Itochu's core story was portfolio improvement, less dependence on volatile resource businesses, and more emphasis on steady consumer-facing and domestic/Asia-linked operations. The 2016 annual report says the company accelerated asset replacement, improved cash flow management, and focused on earn, cut, prevent to build a more durable earnings base. By 2019, that shift was showing up in the numbers and in the strategy. Itochu's annual report says FYE 2019 brought record profit of 500.5 billion yen, driven by growth in the non-resource sector, strong contributions from food and ICT/financial businesses, and the contribution from CITIC alongside a rebound from a one-time loss in the prior year. A simple way to read this period is 2015. Solid base, but still before the big re-rating. 2016, cleanup year, with impairment and asset replacement to reset the portfolio. 2017 to 2018. Earnings improved as the non-resource engine strengthened and CITIC contributed more. 2019, record profit, helped by both operating growth and accounting/one-time effects. Why profit surged in 2019? The surge in 2019 was not just accounting change, but a mix of business improvement and accounting presentation. Itochu's report says the main drivers were increased earnings in the non-resource sector, especially food and ICT/financial businesses, plus CITIC's contribution and recovery from a one-time loss recognized in FYE 2016. The accounting change angle is mainly about the adoption of IFRS from FYE 2015 and later consolidation/segment changes rather than a one-off magic boost. Itochu's 2019 report notes that Family Mart UNY Holdings was referred to under its new name through the report, and the company had been consolidating major consumer platforms like Family Mart UNY Holdings and Pocket Card, which lifted the scale and stability of earnings. So the cleanest explanation is operating improvement, food, textiles, convenience store-related activities, and financial services were performing well. Portfolio effect. Itochu had spent years moving capital into higher quality businesses and away from weak assets. One-time/accounting effects, prior year losses, and consolidation effects made the 2019 comparison look especially strong. Buffett's likely lens. If Buffett studied the 2016 report first, the attractive part would probably have been the discipline. Asset pruning, conservative balance sheet thinking, and a deliberate move toward businesses with recurring consumer demand. The 2016 report repeatedly frames Itochu as building a long-term earnings base rather than chasing short-term commodity exposure. That matters because by 2019, the company looked less like a cyclical trader and more like a diversified consumer and services platform. In Buffett terms, that is closer to a durable compounder than a pure commodity-linked trading house. One important nuance. If you mean what accounting change made profit surge, the answer is that there was not one single accounting switch that mechanically created the whole jump. The 2019 surge mainly reflected stronger underlying businesses, plus consolidation and comparison effects from prior years, while the company's shift to IFRS and portfolio restructuring changed how the results were presented and how large the consolidated earnings base appeared. Gross trading profit at Itochu is the company's top-line trading margin, the gross profit generated from trading and related business activities before SG&A and other operating expenses. In plain English, it is the spread between what Itochu earns from buying/selling goods and services and the direct cost of those transactions. So it is a useful measure of how much value its businesses create before overhead. Why it matters. For a Sogo Shosha like Itochu, gross trading profit is more informative than revenue alone because trading houses often have huge sales volumes but thin margins. It helps show whether the company is improving its business mix, pricing power, and recurring earnings quality. How Itochu uses it. Itochu reports gross trading profit as one of its key management metrics, alongside consolidated net profit and segment performance. The trend has been rising over time, with FY 2017 at 1,210.4 billion yen and FY 2025 at 2,480.5 billion yen, showing how the company expanded its earning base. Investor interpretation. When investors study Itochu, gross trading profit is useful because it can reveal whether growth comes from better business quality rather than just financial leverage or one-off gains. In Itochu's case, sustained growth in gross trading profit has usually been one sign that the non-resource, consumer, and finance businesses are becoming more important. Itochu's CEO objective over 2015 to 2020 was to push the company from a cyclical trading house into a more stable, consumer-linked compounder, while explicitly raising profits, cash returns, and capital discipline. By 2021, that had crystallized into a management plan that aimed at a very high profit base and much more aggressive shareholder returns. Core objectives. The main goals were to grow earnings through downstream businesses, strengthen the non-resource profit base, improve the corporate brand, and keep reallocating capital into higher quality businesses. In the 2025 report, Itochu describes this as profit opportunities are shifting downstream, with growth investments, brand enhancement, and shareholder returns as the three pillars. The company also tied management to sustainability and governance, not just profits. Itochu says it built ESG into its management policy and investment process, including climate, supply chain, and human rights governance. 2021 plan targets. You are referring to the medium-term plan that was disclosed in 2021. Itochu's annual report says it released Brand New Deal 2023 in May 2021, aiming for a new growth stage. The shareholder return policy around this era became clearly more aggressive, with dividend growth and active buybacks becoming a standard part of capital allocation. Itochu's dividend/buyback disclosure shows a strong upward path in dividends and multiple repurchase programs, beginning in 2020 to 2021 and continuing thereafter. What management was trying to do. The CEO's implicit message during 2015 to 2020 was raise profit quality, not just profit size. Shift toward businesses with recurring consumer demand and better capital efficiency. Use asset replacement to exit weaker or more cyclical exposures. Return excess cash through dividends and buybacks once the earnings base became more reliable. That is why the later 500 billion yen profit ambition and aggressive shareholder returns made sense. The company had spent the prior years building the operating base that could support them. Buffett-style read. From a Buffett lens, this was a classic management evolution. Build durable earning power first, then let capital allocation do the compounding. Itochu's own materials show that by the early 2020s, the company wanted to pair growth investment with disciplined returns, which is exactly why it started to look more like a long-term quality compounder than a simple trading company.